You bought the halving narrative, loaded up on your favorite altcoins, and waited for the big payoff. If you followed the 2021 playbook to the letter, you were expecting the inevitable euphoric peak that everyone promised. But here we are in 2026, and there is no massive blow-off top. Instead of a sudden wealth generation event, your portfolio is experiencing a slow, agonizing bleed. The reason your current strategy is failing is that you are trading a ghost. You are waiting for a market cycle that has already quietly concluded. That prior cycle ended under conditions that completely blindsided standard retail technical analysis. If you continue to trade based on that defunct 2021 playbook, you practically guarantee that your account will serve as the exit liquidity for institutional smart money. Look back at the post-halving cycles of 2013, 2017, and 2021. Every single one of those runs ended in wild speculation, rapid retail inflows, and massive spikes in social media engagement. The data proves Bitcoin's October 2025 peak occurred under total retail apathy. Retail participation and social metrics never reached historic highs. This chart shows a classic market breadth collapse. Notice how the primary asset reaches new highs, but the broader market completely fails to participate and steadily declines into the red. Instead of expanding outward into speculative altcoins, capital aggressively concentrated and hid within Bitcoin. Retail traders holding those altcoins were left stranded in a secondary market where risk appetite was completely exhausted. Buying altcoins under the assumption that a rising Bitcoin automatically lifts all boats is a mathematically broken strategy when market breadth behaves like this. Crypto requires a specific type of fuel to run a bull market. It relies heavily on cheap, abundant speculative liquidity from capital that is willing to take on high risk. Right now, that fuel is heavily restricted by elevated real interest rates and delayed policy easing from central banks. Large institutional capital is executing a defensive rotation. They are abandoning speculative digital assets and moving straight into scarce, inflation-protecting assets like gold. Even the Bitcoin ETFs, which provided a massive tailwind of institutional capital earlier in the cycle, have stabilized and plateaued. You might be wondering why, if the cycle actually peaked, the market hasn't just crashed in one dramatic day to reset prices so you can buy the bottom. We are experiencing time-based capitulation. The market is slowly unwinding its excess, slowly grinding down resolve over an extended period rather than breaking it instantly. Mechanically, this translates to endless sideways trading, fake breakouts, and a slow, continuous bleed of your account balance. In a time-based capitulation regime, blindly buying the dip doesn't catch the bottom. It simply provides the necessary exit liquidity for long-term holders to quietly distribute their positions. To survive the 2026 market, you have to accept that the macroeconomic environment dictates the trend. The current restrictive regime strictly favors defense. The structural upside on this market remains capped until we see a massive shift in liquidity, like emergency policy easing from the Fed or a severe break in the labor market. You need to immediately shift your entire trading posture. Stop swinging for home runs and stop trying to catch the bottom on altcoins that are steadily bleeding out. You must heavily restrict your trade sizing and strictly cap your risk exposure to 1 or 2% on every single execution. Your singular objective right now is capital preservation. Surviving the chop with your account intact ensures you are ready to participate when the real institutional accumulation phase finally resumes.